Folks, when Warren Buffett makes a move, the financial world listens. And when he drops millions on a couple of stocks that are trading under $50, that's when the smart money really starts paying attention. We're talking about the Oracle of Omaha here. A man who doesn't chase hype, who isn't glued to screens looking for the next meme stock or speculative rocket ship. No, Buffett plays the long game. While others react to headlines and volatility, he's studying balance sheets, looking for value where others only see noise. And now he's revealed two surprising bets that he's made. And we're not talking about some obscure biotech or unproven tech startup. These are real companies with real revenue, actual profits, and a track record of durability. They're stocks you've probably heard of, but you might not have realized how attractive they are until now. So in this video, I'm going to walk you through exactly what these two companies are, why Buffett chose them, how they're performing financially, and what that might mean for your own investment strategy. By the end of this video, you'll have a solid understanding of what makes these stocks tick and why they caught the attention of one of the greatest investors of all time. Let's dive right in. Stock number 1, Sirius Holdings. The first company on Buffett's radar is Sirius Holdings, ticker symbol SIRI. Now, if that name sounds familiar, it's probably because you've tuned into one of their channels while driving. But here's what you may not know. Sirius is more than just a media company. It's the only licensed satellite radio operator in the United States. That's right, they've got a legal monopoly. This isn't just a competitive advantage, it's an absolute fortress. In a world where companies are constantly battling for attention, Sirius doesn't have to fight other satellite radio providers. Because there aren't any, they are literally the only game in town. And for Warren Buffett, that kind of economic moat, that's pure gold. He's spent his career hunting down companies that have unique advantages that competitors just can't copy. In Sirius case, that moat is carved in stone by regulation and licensing. Think about how many people spend hours every week commuting, road tripping, or just sitting in traffic. Satellite radio becomes more than entertainment. It's a companion, a habit, even a necessity. And Sirius is right there, integrated into millions of vehicles across the country. Now here's where it gets even more interesting. Buffett didn't just dip his toes in the water with this one. He dove in. During a recent buying window from January 30th to February 3rd, Berkshire Hathaway bought over 2.3 million shares of Sirius As of now, Berkshire owns more than 10% of the entire company. That's not a small stake. That's a power move. So why did Buffett jump in now? Let's look at the numbers. In the most recent quarter, Sirius brought in $2.07 billion in revenue. That's a 4.3% decline year over year. Not exactly headline-grabbing growth, I'll admit. But context is key. The media industry has been hit hard across the board. Ad budgets are shrinking, costs are rising, and yet, Sirius still pulled in over $2 billion in a single quarter. More impressively, they remained profitable. Net income came in at $24 million, even after the revenue dip. Yes, it's down from $264 million the year before, but again, this is in the middle of one of the most difficult environments media companies have seen in years. But here's what really matters. Subscriptions. Over 77% of SiriusXM's revenue comes from subscribers. Only about 19% comes from advertising. That means when times get tough and companies start slashing their ad budgets, SiriusXM isn't nearly as exposed as traditional broadcasters. Subscriptions are sticky. Once someone's used to listening to their favorite shows, artists, sports, or talk radio in their car, they're not likely to cancel, especially when it's built right into the dashboard. And it's not just cars anymore. SiriusXM has expanded into mobile, smart speakers, and streaming through acquisitions like Pandora and investments in SoundCloud and podcasting platforms. They're not clinging to the past. They're bridging the gap between traditional satellite and the streaming future. Now let's talk valuation. SiriusXM is trading at just around 7 times forward earnings. That's incredibly low when you consider the S&P 500 average is hovering closer to 20. This is a company that's profitable, generating cash, and has a monopoly. And yet it's priced like a struggling startup. That kind of disconnect is exactly where Buffett sees opportunity. At the time of Buffett's purchase, Sirius XM was trading around $22 per share, still well under $50, which means it's accessible for everyday investors looking to follow Buffett's lead. Let's move on to Buffett's second pick. And this one might just surprise you. Stock number 2, Occidental Petroleum. That's right. Buffett is going big on energy, and more specifically, Occidental Petroleum, ticker symbol OXY. Now, this isn't a new position. Berkshire has been quietly and steadily accumulating shares of Occidental since 2022. But what's striking is how aggressively Buffett is still buying in 2025. On February 7th of this year alone, Berkshire bought 763,017 more shares, spending over $35 million in a single day. That brings their total stake in Occidental and Chevron to over $27 billion. That's not a bet, that's a conviction. But why would Buffett, a man known for avoiding cyclical, commodity-driven businesses, go all in on oil? Let's break it down. The pandemic crashed oil prices. Demand disappeared almost overnight. Energy companies had to slam the brakes on spending. Drilling stopped. Projects were shelved. Now, a few years later, that underinvestment is catching up with us. We're seeing tight supply and rising demand, especially as travel rebounds and emerging economies continue to grow. Add in geopolitical tensions, like the war in Ukraine and instability in the Middle East, and you've got the ingredients for a long cycle of higher oil prices. And that's exactly the environment where Occidental shines. They're what's called an upstream producer. That means they make most of their money from drilling and selling oil. So when oil prices go up, their margins expand dramatically. In the first quarter of 2025, Occidental generated $3 billion in operating cash flow, just in 3 months. Daily production exceeded 1.39 million barrels per day, and domestic operating costs came in at a super-efficient $9.50 per barrel. That's excellent efficiency. Adjusted earnings were 87 cents per share, and free cash flow came in at $1.2 billion. They ended the quarter with $2.6 billion in unrestricted cash, giving them flexibility to reinvest, pay dividends, or buy back stock. And they've been laser-focused on their balance sheet. Remember when they bought Anadarko Petroleum? That left them with a ton of debt. But Buffett saw the long-term value. And now, Occidental is paying down that debt fast. In just the first few months of 2025, they retired $2.3 billion in debt. Over the last 10 months, that number jumps to $6.8 billion. That move alone has cut annual interest expenses by $370 million. That's more money flowing directly to the bottom line. Beyond oil, they've got solid diversification. Their chemicals division, called OxyChem, brought in $215 million in adjusted earnings last quarter. And their midstream operations, the pipelines and infrastructure, are doing well too, especially in the Permian Basin, one of the most important oil-producing regions in the U.S. Even better, Occidental recently cut its capital spending guidance by $200 million and is expecting $150 million in operational savings this year. This is a lean, efficient company that's not just riding oil's comeback, it's driving it. At around $41 per share, Occidental is still undervalued compared to many large-cap energy stocks. The forward PE is around 13, which is still a bargain in a market where tech companies are pushing valuations into the stratosphere. So let's take a step back. You've got Sirius XM, a legally protected monopoly with subscription revenue, sticky users, and a rock-bottom valuation. And you've got Occidental Petroleum, a cash flow machine perfectly positioned for a multi-year oil cycle with a cleaned-up balance sheet and massive backing from Berkshire Hathaway. Different industries, different business models, but the same investing DNA. Durable advantages, strong cash flow, low valuations, and long-term potential. Buffett isn't trying to time the market. He's finding great businesses at great prices and holding them until the rest of the market catches on. That's the power of value investing. And it's a strategy anyone can follow. And the best part? Both of these stocks are still trading under $50. You don't need to be a billionaire to get in. You just need to be patient, consistent, and willing to think long-term. If you got value from this breakdown and want more insights like this, make sure to subscribe and tap that notification bell. I break down market moves, smart investing tips, and the strategies of legends like Buffett, all in plain English. Let's aim for 100 likes on this video. That helps more people discover content like this and build smarter portfolios. Thanks for watching, and as always, invest wisely.